Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about 3 Million Company Annual Report. The 3 Million Company provides a wide range of diversified technology services across various industries. The company operates through three main segments: safety and industrial, transportation and electronics, and consumer. The safety and industrial segment offers products such as industrial abrasives, autobody repair solutions, personal hygiene products, electrical materials, structural adhesives, tapes, and respiratory protection solutions. These products cater to the needs of various industries, including metalworking, construction, and maintenance. In contrast, the transportation and electronics segment provides ceramic solutions, attachment/bonding films, sound management for transportation vehicles, graphic films for advertising, reflective signage, light management films, chip packaging solutions, semiconductor production materials, and data center solutions. These products are designed to enhance safety, efficiency, and performance in the transportation and electronics industries. The consumer segment offers a variety of products including cleaning supplies, air quality products, picture hanging accessories, retail abrasives, paint accessories, stationery, office products, automotive appearance products, and consumer bandages, tapes, braces, and supports. These products cater to the needs of individual consumers for their daily lives. Overall, 3 Million Company's diverse product offerings make it a leading provider of technology services across various industries. The stock price of 3 Million Co. has remained relatively stable over the past year, with no significant changes exceeding a 4.57% movement. However, several major news events have impacted the company's stock performance during this period. One such event was the announcement of 3 Million's quarterly dividend in February 2026, which typically has a stable impact on the stock price. Additionally, the company filed for an automatic mixed securities shelf offering, an annual report 10-K, for 2025, providing flexibility to raise capital and offering a comprehensive look at the company's financial performance. However, not all news events had a significant impact on the stock price. For instance, the announcement of 3 Million's upcoming investor event in January 2026 did not cause any notable movement in the stock price. Similarly, the debut of AI-powered assistant, Ask 3 Million, an expanded 3 Million digital materials hub at CES 2026, also did not have a significant impact on the stock. On the other hand, some news events caused substantial movements in the stock price, exceeding the 4.57% threshold. For example, the company's shares plunged 7% following the Q4 2025 earnings announcement, despite beating analyst estimates. This event highlights the volatility and unpredictability of the stock market. In conclusion, while several major news events impacted 3 Million's stock performance over the past year, none of them caused a significant change, exceeding a 4.57% movement in the stock price. The company's stable dividend announcement and flexibility to raise capital through its filing for an automatic mixed securities shelf offering contributed to its relatively stable stock price. 3 Million Company market capitalization of $83 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that 3 Million Company holds a significant advantage in their industry. 3 Million Company trades at a higher price-to-earnings ratio of 26 times and a higher price-to-book ratio of 17.39 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 90% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and his management is unable to expand the business. The primary drivers of revenue growth or decline for 3 million are multifaceted. On one hand, certain segments such as safety and industrial have shown net sales growth and operating income growth, driven by innovative products like respiratory protection solutions and advanced ceramic materials. In contrast, the transportation and electronics segment has experienced a decline in net sales and operating income due to decreased demand for light management films and electronics assembly solutions. However, several external factors are also impacting 3 million's revenue. The company is facing significant challenges related to PFAS, including regulatory actions, fines, and lawsuits, which may impact sales and revenue. Additionally, the discontinuation of PFAS manufacturing by 2025 will likely have a lasting effect on the company's revenue. Furthermore, internal factors such as cost of sales and expenses are also affecting profitability. Decreases in research, development, and related expenses may impact innovation and growth, while asset changes, including decreases in assets for the transportation and electronics segment, are also contributing to the decline in revenue. Overall, 3 million's revenue growth or decline is being driven by a complex interplay of internal and external factors. The net income of the company experienced a significant decline between 2024 and 2025, decreasing by 56% and $923 million. This downturn was largely attributed to various external factors such as global economic downturns, trade tensions, and geopolitical risks. Additionally, increased production costs, higher energy and commodity prices, and lower consumer demand further exacerbated the decline. The profit margins of the company also underwent a change during this period. The operating income margin decreased by 1 percentage points from 2024 to 2025 on a GAAP basis, but increased by 2 percentage points on an adjusted basis. However, when considering the year-over-year change, the operating income margin actually decreased from 18.8% in 2024 to 17.4% in 2025. The reasons behind these changes are multifaceted and include factors such as foreign currency exchange rate fluctuations, tariffs, disruptions in supply chains, reduced sales and revenue due to limited access to end markets, higher production costs, product pricing uncertainty, and cost of sales increases due to foreign currency impacts, tariffs, and litigation costs. Furthermore, the company's divestitures and goodwill impairment loss also contributed to the decline in net income. In summary, the net income and profit margins of the company underwent significant changes between 2024 and 2025, primarily driven by external factors such as global economic downturns, trade tensions, and geopolitical risks. The company's ability to adapt to these challenges will be crucial in determining its future performance. The company's financial performance indicates a consistent generation of positive operating cash flow over the past 3 years. In 2025, the company generated $2,306 million in operating cash flow, showing a steady increase from the previous year. However, it is worth noting that there was a significant drop in operating cash flow in 2024 to $1,819 million compared to the high of $6,680 million in 2023. Despite this fluctuation, the overall trend suggests that the company is capable of generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level has undergone significant changes over the past year. According to various reports, the total debt decreased by $1.8 billion from December 31, 2024 to December 31, 2025. This decrease is also reflected in the long-term debt, which dropped from $11,125 million to $10,932 million. Additionally, the company's long-term debt level has decreased significantly, with a carrying value decrease of $236 million and a fair value decrease of $67 million. However, the interest expenses have shown mixed results. While some reports indicate an increase in interest expense from $1,102 million in 2024 to $1,235 million, others show a decrease in interest expenses from $1.19 billion in 2024 to $946 million in 2025. Furthermore, there were significant changes in interest expenses related to foreign currency forward/option contracts, with a pre-tax gain of $77 million recognized in other comprehensive income in 2025, and a pre-tax gain of $128 million recognized in 2024. Overall, the company's debt level has decreased significantly, but the interest expenses have shown mixed results. The performance of various segments and regions within the company has been mixed. The safety and industrial segment has shown strength in sales, with a sales growth of 3.2% in 2025 and an operating income margin of 24.9% in 2025. This segment's subsegments, such as electrical markets, industrial adhesives and tapes, and personal safety, have also performed well. In contrast, the transportation and electronics segment has struggled, with a revenue decrease of $1,093 million in 2025 compared to the previous year. The consumer segment has also experienced softness in sales, with capital spending decreasing across all regions: Americas, Asia-Pacific, Europe, Middle East, and Africa. Specifically, the Americas region saw a significant decline in capital spending from $829 million to $663 million, while the Asia-Pacific and Europe, Middle East, and Africa regions also reported decreases in capital spending. Management is emphasizing the importance of driving long-term value through innovation, operational excellence, and strategic investments. To achieve this goal, the company will continue to invest in its operations, including reviewing acquisition opportunities to drive growth. Additionally, management is focused on making investments in new business systems and solutions to enhance productivity. The company has also implemented various strategies to manage risks associated with exchange rate fluctuations and interest rate changes through hedging instruments. Furthermore, management is committed to returning cash to shareholders through dividends and share repurchases. The company's strategic asset allocation of its pension plan includes investments in global equities, private equities, fixed income, and absolute return investments. In terms of cost discipline, the exit of PFAS manufacturing and the spin-off of Solventum are contributing to cost dyssynergies. However, management views these moves as necessary steps towards driving long-term value. Overall, the company's strategy is centered around growth, productivity, and cost discipline, with a focus on making strategic investments to drive future success. The acquisitions and divestitures made by the company are significant milestones in its history. On one hand, the company has made strategic acquisitions to expand its capabilities and offerings. For instance, Yarrow Holding Corp., parent of Yarrow Technologies, was acquired by a subsidiary of $3 million on April 1, 2008. This acquisition likely brought new technologies and expertise to the company. On the other hand, the company has also made significant divestitures to streamline its operations and focus on core businesses. The spin-off of the healthcare business is a notable example, where 80.1% of Solventum Corporation shares were distributed to 3 million stockholders on April 1, 2024. This move likely allowed the company to concentrate on other areas while also providing shareholders with value. The company has also exited PFAS manufacturing and is working to discontinue its use across its product portfolio. This decision reflects a commitment to sustainability and reducing environmental impact. Furthermore, the divestiture of Solventum Corporation within 5 years and the retained equity interest in Solventum, intended to be divested within 5 years, demonstrate the company's efforts to simplify its operations. In addition, the termination of fixed-to-floating interest rate swaps returned $800 million of notes due in 2049 and 2050 to fixed-rate debt. This financial move likely helped the company manage its debt and improve its financial position. Overall, these acquisitions and divestitures have contributed to the company's growth, sustainability, and financial stability. The company has a history of paying dividends and buying back shares to reward its shareholders. In terms of dividend payments, the company has consistently paid quarterly dividends since 2025, with each quarter amounting to $0.73 per share. Additionally, in 2024, the company declared a total of $1.51 per share for Cone, followed by $0.70 per share for Q2, Q3, and Q4. Furthermore, the company has also been actively buying back its outstanding common stock. In fact, it has authorized up to $7.5 billion for repurchase, with a total of 1,055,270 million shares purchased so far. The company's share buyback activity continued in 2025 and 2024, with $3.3 billion and $1.8 billion spent respectively on buying back its own stock. Concerns about inventory buildup and supply chain disruption. The company faces several concerns regarding inventory buildup and supply chain disruption. One of the primary concerns is the potential for tariffs and trade restrictions to disrupt established supply chains, forcing the company to find new suppliers or relocate production, page 16. This could lead to significant costs and logistical challenges. Another concern is the uncertainty surrounding alternative goods and services in case Solventum's products are no longer available. The possibility of more expensive alternatives adds to the risk of inventory buildup and supply chain disruption, page 20. Furthermore, regional sales data indicates a potential issue with inventory buildup in the Americas region, where organic sales change was minus 3.1%, page 28. This suggests that there may be an accumulation of unsold products, which could lead to reduced cash flow and decreased competitiveness. Regulatory changes and restrictions on PFAS-containing products also pose a risk to supply chain continuity, page 84. These changes could disrupt the company's ability to source essential materials, leading to potential supply chain disruptions. That concludes the financial summary for 3 Million Company. Feel free to comment below, and I will be happy to answer them when possible.